Hello and welcome back to Beyond the Charts. This is a series where we break down what is exactly happening in the world of finance and the economy through charts in a way that is easy for all of us to follow and understand. If you are curious about the charts and the sources which we have mentioned in the video, you can check out our newsletter. The link is in the description below. With that, let's get on to the episode for today. See, in June 2025, AMFI released the mutual fund flow data, which gave us a very interesting picture of how investors have behaved so far this year. And now that we are halfway through the calendar, it is a very good time to sort of pause and take a look at what things are doing. See, the past 6 months have been full of global uncertainties. You have things like ongoing wars, growing tariff tensions, and also constant shifts in the economic outlook, so to speak. The events have sort of left investors around the world quite uneasy, and Indian markets have also felt the ripple effects of this. But the thing is, if you really want to understand how investors are responding to all of this, one of the best places to look is actually mutual fund flows. See, between January and June 2025, the total assets that were managed by mutual funds in India went up by more than 7 lakh crore rupees. In January, the AUM stood at 67.25 lakh crore rupees. By June, that number had grown to 74.41 lakh crore rupees, which is an increase of roughly around 11%. Now, this growth came from two main things. The first one is the rising value of investments which were already made, and the second was fresh inflows of money by investors into different kinds of funds. Now, overall, the mutual fund industry received net inflows of 4.18 lakh crore rupees in the first half of this particular year. Now, to understand just how strong this momentum is, let's look at the history first. See, if you leave out 2024, the inflows in just these 6 months are higher than what most entire years have seen since the year 2000s. That is how strong investor participation has been so far in 2025. Now, let's move on and dig into the specifics. See, of the 4.18 lakh crore rupees that I mentioned which came into mutual funds, 1.6 lakh crore rupees went into specifically equity funds. Now, these funds have been seeing constant inflows ever since 2021. In fact, even during periods of market stress after COVID-19, people kept putting money into equity funds, and that trend has not yet reversed. But there has been a definite slowdown. To give you a better sense, between May 2024 and January 2025, the monthly inflows into equity funds used to hover between 35,000 crore rupees and 40,000 crore rupees. But since February 2025, that number has dropped to around 24,000 crore rupees per month. But that said, despite the slowdown, the total assets under management or AUM in equity funds have continued to grow. In January, for instance, they were at 29.5 lakh crore rupees, and by June, they had climbed to 33.47 lakh crore rupees. So even though the pace of new investments have definitely slowed down, the market value of these investments is still definitely going up. Now, one reason for this drop in monthly flows is the cooling off of thematic and sectoral funds. Now, these funds were extremely popular not very long ago. In December 2024 alone, they attracted more than 15,000 crore rupees. But by end of June 2025, that number had very sharply fallen to just 476 crore rupees. Now, for your quick context, these kind of funds allow investors to bet on specific sectors like, let's say, infrastructure, defense, green energy, or even tourism for that matter. And since July 2023, sectoral and thematic funds had bought in nearly 2 lakh crore rupees, which is roughly about a third of all the money that came into equity funds during that specific period of time. But now that trend has clearly lost some steam. Over the last 4 odd months, they have pulled in just around 4,500 crore rupees. And this slowdown could be happening for a few reasons. The first one could be the rise in global uncertainties like tariff-related tensions and so on and so forth. Now, these of course make investors like you and I and everybody else also very nervous about concentrating our bets in just one single sector. The other reason could be performance. See, these funds did really well over the last few years, but as of late, the results have been slightly on the underwhelming side. To give you a slightly better sense of this, in the last 1 year, only 3 thematic fund categories have given average returns above 10%. And in 2025 so far, just one category has managed to cross that very benchmark. But that said, while sectoral funds have lost momentum, other categories are still holding fairly strong. For example, flexi-cap funds have continued to attract steady inflows with 5,733 crore rupees coming in during the month of June alone, which by the way is the highest across categories. Mid-cap, small-cap and multi-cap funds are also seeing some healthy interest. So even though thematic bets are definitely fading, broad-based equity investing remains very much alive as well. Now, this consistent domestic investing has led to a major shift in who really owns Indian equities. Domestic institutional investors, or which are also called DIIs, which basically include mutual funds, insurance companies and other institutions based in India, India now hold about an 18% share in Indian equities. That is more than the 17.5% that is held by foreign institutional investors or FIIs as of March 2025. Now, this reversal basically shows just how strong the domestic investor base has become. But anyway, let's now move on to debt funds, where the story is a little bit more on the mixed side. See, in April 2025, inflows into debt funds spiked to 2.19 lakh crore rupees. But this was not because of a sudden surge in investor enthusiasm. It's actually a seasonal effect. Let me explain this. See, at the end of the financial year, companies usually park their surplus funds in liquid and money market schemes for short durations of time. Once they pay out bonuses, taxes, and other liabilities that they have, that very money then gets withdrawn eventually. Now, that is exactly what happened in May and June. Just in those two specific months, liquid funds saw outflows of over 65,000 crore rupees, which dragged overall debt flows into negative territory. But that said, there are a few debt fund categories which are definitely benefiting from the broader trend of falling interest rates. The Reserve Bank of India, or the RBI, has already cut the repo rate by a full percentage point in 2025, where they have brought it down to 5.5% as of June 2025. Now, of course, when rates fall, certain debt funds do better. For instance, short duration funds saw inflows of 10,277 crore rupees in the month of June, and corporate bond funds attracted 7,124 crore rupees. But on the flip side, overnight and ultra short duration funds, which are by the way higher suited to high rate environments, continue to see outflows. So as returns in these ultra safe categories are falling, investors are moving their money to other places. That said, hybrid funds tell a very different story over here. Now, these, by the way, are funds that mix equity, debt, and sometimes also gold. In December 2024, hybrid funds saw net inflows of 4,370 crore rupees. But by June 2025, that number had grown to 23,223 crore rupees. One big reason for this is the rising popularity of arbitrage funds, which bought in 15,585 crore rupees in June alone. For quick context, these funds basically make money from the difference between spot and future prices, and when markets are volatile, those gaps obviously get bigger. So arbitrage funds basically become attractive to investors who are looking for relatively low risk ways to earn returns. Now, along with arbitrage, multi-asset and dynamic asset allocation funds are also seeing some inflows. Now, these funds automatically rebalance between asset classes based on market conditions. So with equity markets turning a little bit on the choppier side and debt returns coming down due to interest rate cuts, investors are heavily looking for balanced options that offer a bit of everything. Now, in terms of asset growth, hybrid funds have done fairly well. Their total AUM has grown 13% in the first half of 2025, while debt fund AUM has remained mostly flat. Moving on, NFOs, or new fund offerings, which are used by fund houses to launch new schemes, have slowed down fairly sharply. In 2024, monthly NFO collections averaged around 10,000 crore rupees. This year, that number is down to around 3,100 crore rupees. And this slowdown reflects the broader investor caution in a very volatile market. But on the passive side of investing, index funds and ETFs have had a fairly mixed year. Index mutual funds, which track benchmark indices like Nifty or Sensex, were getting inflows of around 4,000 crore rupees a month in 2024. And in 2025, that very number has dipped to under 2,000 crore rupees in the month of June. But still, the AUM of index funds continues to rise and has reached 3.4 lakh crore rupees. Gold ETFs has also seen a burst of interest. Like we all may know by now, gold prices have surged from around 63,000 rupees per 10 grams in late 2024 to even crossing the 1 lakh rupee mark. And this has largely been driven by global uncertainty, geopolitical tensions, and a strong demand from central banks. And even though most Indians still prefer physical gold, gold ETFs have actually managed to attract more than 19,000 crore rupees in inflows this year, and now they manage more than 65,000 crore rupees in assets. Other types of ETFs, like those which are based on specific strategies or sectors, have shown fairly inconsistent flows. March and April saw strong inflows, but things have slowed down ever since then. Now, fund of funds, or FOFs, that invest in overseas assets have also struggled here. See, ever since SEBI put limits on international FOF investments in early 2022, funds have been negative ever since. Even after some flexibility was allowed sometime later, the recovery has honestly been slightly on the modest side. But anyway, now let's move on and talk about SIPs, which is the one area where the headline numbers look very strong. See, SIP inflows have consistently stayed above 20,000 crore rupees a month ever since May 2024, and in June 2025, they hit a record 27,269 crore rupees. rupees. But there is more to the story. See, the number of people stopping their SIPs has increased sharply lately. The discontinuation ratio, which basically is how many SIPs are stopped for every new 100 ones which are started, has risen from 58.7% in June 2024 to 77.8% in June 2025. That is a very big jump, and in April specifically, there was a massive jump in discontinuations. To be specific, 1.62 crore SIPs were marked as stopped. Now, a part of the reason for this is a new way of counting. See, AMFI follows SEBI rules which say that if 3 consecutive SIP payments fail, the plan is treated as discontinued. So there was a one-time adjustment for that for sure. But even if you leave that part aside, there is a definite and clear trend. The number of new SIP accounts being added every single month has fallen by roughly half as compared to last year. To give you a reference, in June 2024, over 22 lakh new SIPs were added, but in June 2025, the number was just 13.75 lakhs. But that said, despite all of that, the total AUM in SIPs grew 23% year over year to 15.31 lakh crore rupees. Now, this suggests that while fewer investors are joining, existing investors are contributing larger amounts of money. In fact, the contribution rate, which by the way measures how many accounts are actively paying every single month, has improved from 74.6% to 94.1%. So basically, even though the growth in the number of new accounts has definitely slowed down, the quality of contributions has definitely gone up. There are some long-term shifts here as well. Regular mutual fund plans are more likely to have long-lasting SIPs. As of March 2025, 1 out of every 3 SIPs in regular plans had been active for more than 5 years, which is up from just 12% in the year 2020. But that said, direct plan investors are catching up very quickly. SIPs held for over 5 years in direct plans have grown from 4% to 19%, and the number of very short-term SIPs, which are those held for less than a year, has fallen from 49% to 30%. Now, interestingly, this trend is not limited to big cities either. Whether it is the top 30 urban centers or smaller towns, SIPs are being held for longer on an average. To give you a sense, back in 2020, only 4 to 5% of SIPs in these regions lasted beyond 5 years. But in 2025 right now, that number is close to 30%. And at the very same time, the share of short-term SIPs has dropped from over 40% to just around 21 to 23%. So the thing is, while new SIP registrations are slowing down, the behavior of existing investors is becoming more and more mature and also consistent. People are holding on longer, they are contributing more regularly, and they are increasing their average SIP amount over time. So all in all, the mutual fund trends in the first half of 2025 give us a very interesting picture of cautious optimism, so to speak. Investors are not rushing in blindly, but neither are they panicking. They are sort of rebalancing, they're shifting strategies, and they're becoming maybe more thoughtful with their money. That's all for this episode. We would love to know your thoughts in the comments as to what we could do better and also maybe what we already did better this time around. With that, this is your host Anurag Bansal signing off. Take care and have a nice day. Bye-bye.